JP Morgan Chase CEO Jamie Dimon releasing his annual shareholder letter saying President Trump's tariffs will likely boost prices on both domestic and imported goods while slowing growth. But he hopes the U.S. will see some positive benefits in the long term. Dimon, now the first Wall Street bank CEO to address the tariff policy amid the market sell-off. Joining us now with more, Devin Ryan, Citizens Director of Financial Technology Research. And Devin, all of this coming as we're heading into bank earnings, and Morgan Stanley is downgrading the entire banking sector amid recession risks looming. To what extent do you think financials are unbuyable if we are heading into a recession?
Hey, good morning, Maddie. It's obviously a complicated equation. We came into this year and there was a lot of enthusiasm, particularly for the capital markets recovery and kind of the cyclical businesses just on pro-growth, less regulation, and really just time going by where people are feeling like we're in a better moment. And now I think that is in jeopardy. When I take a step back, we were expensive coming into the year. We've now reversed kind of that whole valuation dynamic, and now we're trading at pretty actually below average multiples on our view of normalized earnings, and that's always kind of grounded us. So of course, in a recessionary environment, which I don't think is the base case in our model at this point, but in that environment, there's still some more downside in these stocks. But when you zoom out, if you can buy good businesses, depending on what your time horizon is, there are already some opportunities that we think are being created. I think it's just a matter of what your time horizon is and what you're looking to accomplish in your portfolio.
It's so interesting, Devin, because within the complex of normalized earnings, that would also rely on a few of the inputs remaining the same, which was also kind of pointed out within Jamie Dimon's shareholder letter, talking about where there is still global partnership, but sure, better trade deals that get netted out. And I think a lot of businesses have tried to figure out as well for themselves, if you did see an abnormal environment start to play out where they can't rely on some of those global partnerships because there is such a repatriation of either consumer sentiment or of some of the business efforts and thus dealings. And then you have to figure out how much of that output and productivity needs to come centrally from the U.S. How does that then put even more of a strain or reset some of the valuations to a point where we need to start thinking about valuations in an abnormal type of setting?
Sure. Well, I've done this for over 20 years. We covered, financials through the financial crisis. You had, Brexit. You had, the COVID. You had the 2022. The wars and interest rates. And every time, it's something different. And I agree. This is complicated, and you're trying to kind of update your models. You're kind of chasing your tail a bit, right, in the near term. That being said, when you do take a step back, there are underpinnings for a lot of the businesses, the companies we cover, whether it's wealth management, where people need financial advice, whether it's investment banking. You look at the private equity sector, portfolios are at the longest duration they've been at in 20 years. They're 6.7 years right now versus an average of 5.5 years. So there's a lot of tension that's been building where companies need to make strategic decisions. They need to buy other companies. They need to raise capital. That's all already been on pause for 3 years. And so absolutely, this will make things more complicated. But for companies, particularly the companies I cover that are investment banks, that are providing advice, companies are going to need advice getting through this moment. So things will take a little bit of a pause here, without a doubt. But then we will get back to an environment where I think there's going to be a lot of demand for the services of the companies that I cover.
So what are you anticipating then when it comes to earnings results this Friday in terms of net interest income and in terms of any warnings moving forward that could be a risk to NII?
Yeah, I think companies are going to have a hard time giving anything with precision, right? Yeah. We are still in the middle of this. And so I think that companies are going to be very guarded in terms of what they say that would be kind of a long-term view. Anything short-term, I think, is going to be dictated by what they're seeing in the market really, at this point in time. But I don't think you're going to get a lot of guidance on areas like net interest income, or if you do, it'll be with a kind of a broad scenario range. And so my view is earnings, I hate to say they don't matter, but right now we are in a macro market. Macro first, meaning what happens with tariffs and really the ultimate economy is what's going to drive sentiment in these stocks. And so if we get any view of stabilization, even if it doesn't help earnings in the near term, these stocks do well, and vice versa. If you start to see this trickle into the real economy and a slowdown, then like I said, there's still more downside in stocks in a recessionary scenario. But I like where we've come off of. We came into the year with valuations really at kind of record highs. We've now taken all that excess out. We're below average. So we're starting to get into more interesting areas, I think, for investors that have a longer term horizon.
Devin, what's all this mean for underwriting too for some of these banks? If you start to hear IPOs or if you start to hear in the deal making environment that there's more hesitancy.
Yeah, well, it's already happening. So the interesting thing is, companies haven't been able to go public for really the past few years. 2021 was a record. The last few years have really slowed. But part of that is because companies weren't ready to go public. The investors demanded that companies get to profitability and really change how they deliver results. And so what's finally happened is a lot of companies that were, I think, looking at the public markets have finally gotten their businesses to a place where they're ready. Now the markets aren't ready for them at this moment, but there's a backlog building of companies that want to get in the public market. And the reality is they're better quality companies than we've really ever seen, in my opinion, trying to come public. So it's a coiled spring. It's a matter of when, not if. The current moment's going to be tough. Companies are not able to get out into this type of market, but there are a lot of really high quality companies that are in the press that have suggested they want to come public, and we think there's a big pipeline even before what is broadly known about at this point.
Yeah, we've been able to keep tabs with some of those companies and their leaders as well here on Yahoo Finance. Devin, thanks so much for taking the time here this morning. Appreciate it.